All right, welcome back. All we got time for is asking you what you got on the big show tonight.
I am so excited. There's a company called MNTM that came public recently.
All right, welcome back. All we got time for is asking you what you got on the big show tonight.
I am so excited. On non-linear. And by the way, the person who has been alive and made the company come to life is Ryan Reynolds. He's got some great stuff on their website. Then Tom Jordan, considered to be the dean of the oil business. I would point out that someone like Mark Douglas and someone like Reddit, this is the new way to advertise. And you get very good deals if you advertise with them. And you could easily do it. Come up with an ad that you did through Figma by yourself, give it to him, make money, get the return. It's a very exciting time. And that's an example, by the way, of things that create new jobs from AI. So I want to be open-minded that there is an AI job creation case.
No, we have to be hopeful for it and open-minded to it.
But it should be the theme of
being
our
aware
show for the next 5 years.
That the dislocation could be the likes of which we've never seen.
I don't know what we're going to do with all these people who got a college degree, paid $90,000, $400,000, and boom, no jobs. No jobs.
Yeah. All right. Keep thinking about it. Let me know if you come up with something. Coming up, more of what President Trump had to say this morning on CNBC. Keep it here.
The market is open.
Us.
Good Tuesday morning. Welcome to Squawk on the Street. I'm David Faber with Leslie Picker and Mike Santoli. We're live from Post 9 at the New York Stock Exchange. Carl and Sarah have the morning off. Let's give you a look at the markets a half hour into trading, and we'll also have you look at Treasuries. There you can see the yield up ever so slightly on the 10-year at 4.2%. The S&P barely in positive territory with the NASDAQ more significant gain. Coming up on today's show, Goldman Sachs Chief U.S. Equity Strategist David Kostin will join us right here at Post 9. We'll get his takeaways from earnings season so far and where he thinks the market will head next. Plus, we're going to talk Palantir. That stock is at record highs as the company hits $1 billion in revenue for the first time. Also lifts guidance thanks to, what else? AI.
But first, breaking economic data just crossing the tape. Rick Santelli has that for us. Hi, Rick.
Hi, Leslie. Indeed, we had S&P Global final reads for July. Now we're having ISM service sector PMIs. These are fresh, first-time look at July. Expecting 51.5-ish on the headline. Comes in light. 50.1, sequentially lower and light expectations. The weakest since, well, just a couple months ago, May of this year. If you look at prices paid, it's going in the wrong direction. 69.9, following 67.5, well above expectations. 69.9 would be the highest rate of prices paid since October of 22. Look for yields to pay attention to that potentially. And new orders, 50.3, 51.3 in the rearview mirror. So that's sequentially light. Lightest since a couple months ago, the month of May. And finally, the employment index. 46.4 follows 47.2. 46.4 would be the weakest since March of this year. So these numbers do disappoint on the service sector. But instead of paying more attention to the prices paid's inflationary implications, it's the weakness that seems to be taking the market as yields are moving down just a bit. But I don't want to overemphasize how tight these ranges are. Basically 421 and 10s. We've seen it a lot the last 72 hours. Mike, back to you.
Sure have. Rick, thank you very much. Let's turn now to the latest on trade. President Trump commenting this morning on Squawk Box about negotiations with China and India. Megan Casella has the highlights. Hi, Megan.
Hey, guys. Good morning. So quite a newsy interview, especially on the trade front this morning. The president really touting the deals that he's struck with the European Union, with other countries as well. But he also talked about one country whose tariff rates might change before that implementation date on Thursday, and that's India. Take a listen here.
So we settled on 25%, but I think I'm going to raise that very substantially over the next 24 hours because they're buying Russian oil, they're fueling the war machine, and if they're going to do that, then I'm not going to be happy.
So not appearing to have settled, guys, yet on what rate he will be lifting that 25% level to, but clearly going to be something substantial for a pretty sizable U.S. trading partner. He had said that the India tariffs would take effect on Thursday. The secondary tariffs against Russia, he had previously said would take effect on Friday. So we are expecting some final movement and something to be signed to that effect later this week. The president then also spoke about China. He said things are going well there. He believes they have the makings of a deal, but he didn't go so far as to guarantee a meeting between him and Chinese President Xi Jinping later this year. Take a listen to that.
He asked for a meeting, and I'll end up having a meeting before the end of the year, most likely, if we make a deal. If we don't make a deal, I'm not going to have a meeting. I mean, you know, what's the purpose of meeting if we're not going to make a deal? But we're getting very close to a deal.
Now, guys, the president has been very sensitive to this idea of whether he or whether she first reached out and asked for a meeting. Chinese experts that I've spoken to say it's unlikely the Chinese were the ones asking for the meeting. And they also say it's unlikely that the president, Xi Jinping, I should say, would agree to a meeting or some sort of a summit unless there was a deal in hand. So that's something to watch as we wait to see if something like that gets put on the calendar. Guys.
Yeah, Megan, it's David. Any idea where India might end up and what exemptions, if any, will be a part of that? You know, I kind of also find myself wondering about Apple, which, as we've made the point, has moved much of the production of its iPhone meant for the U.S. market to India and what the impact might be if that's not in some way exempted.
We don't have any hard numbers yet for India. The president this morning just saying he was increasing it very substantially. But when he's talked about these secondary tariffs targeting Russia in the past, and China and India would be the main countries being affected by that, he's talked about secondary tariffs as high as 100%. If that's additive, does that mean 125% against India? And then we're back in the territory of where we were with China earlier this year. Exemptions are the biggest question, and I'd say it could go either way there. Mostly, this White House has said they haven't wanted to offer most exemptions, but on some of the heftiest tariffs we've seen so far, Brazil being the most recent example, those 50% tariffs, the exemptions have been quite sweeping. So it's sort of a wait and see. We'll see what we can hear from the White House throughout the rest of the day today.
All right, Megan, we'll be watching. Thank you, Megan Casella in D.C. Let's get back to the markets. The S&P, the NASDAQ, and the Dow all coming off what was the best day they've had since May 27th. Goldman Sachs Chief U.S. Equity Strategist David Kostin joins us here on set. David, good to have you towards the end of earnings season. And I wanted to come to you on something we were discussing yesterday, which was the market outperformance on earnings growth of the Mag 7 minus NVIDIA, so really 6, right, versus the rest of the market. You make a point of it as well in your notes, 26% year-over-year earnings growth versus something like 4% for the rest of the S&P.
Right.
What do we make of that, and what does that mean for the market?
David, I think the thing you should take away from that is the expectation was going into earnings season was it would be 14 percentage points, and it ended up being 22 percentage points. I think that is a key number to think about, that the surprise, the magnitude of the surprise, was really concentrated in those magnificent 6 until we get the NVIDIA in a couple of weeks. So I think that's a key issue. I think the broad takeaway from earnings thus far, we're about, at the end of this week, we'll be about 85% of the way through earnings season, is that you had positive surprises, you had guidance, and the commentary from management was generally positive. And that's a good backdrop for equity market, generally speaking. So first of all, you had 2/3 of the companies beat earnings expectations. So expectations coming in was around 4 percentage points of earnings growth. It ended up being thus far 9. So that's a positive surprise. Now, admittedly,
although almost all of it was due to 6 companies.
A lot of it came from there.
But the rest was 4%.
Correct. It was still positive, surprises or expectations. The second is the improvement, the guidance, and companies were raising guidance. And I think here you get a sense of the breadth of what's taking place. You had basically half the companies this quarter raise guidance for the forward year, whereas in the first quarter, only about a quarter did. So therefore, you had these results, and to your point, yes, you had good results in the Magnificent 6 thus far, but really it was the breadth of their commentary. And then the third issue we take away is, what did management have to say about things? And they are of the view that they can mitigate the cost of these tariffs. And that's an important distinction. That's really where most of the portfolio managers are really asking a lot of questions on right now. It's tariffs and rates. And the tariff side of it is 60% of them expect to raise rates. 75% think they're going to push back on their suppliers. And ultimately, they will be able to maintain their margins.
60% think they're going to raise prices.
Expect to raise prices.
They're going to push back. But
right, in terms of their commentary. And obviously, some of that they'll have to absorb as well.
Do you think they would actually say, though, if they weren't able to mitigate the tariffs? I mean, coming onto the conference call, isn't their job to be like, guys, we've got a plan, here's what it is, and we'll kind of find out later what the real impact is going to be?
Well, Leslie, it's an excellent point, because some of the commentary in Washington, D.C. looks at, are companies actually going to raise prices? But they have a fiduciary obligation on behalf of transmitting to shareholders what's actually likely to happen, and their policy and their strategy is to raise prices right now. I'm not saying their only strategy, obviously looking to push back on their suppliers and try to reduce the input costs, but ultimately someone has to pay for the tariffs. And thus far, managements have said they're able to cut costs and push back the suppliers and raise prices, and thus far maintain their margins. And that's really the key issue, because the economy is growing at around 1% rate. That's real GDP 1% below trend. You have inflation that's closer to 3%. That means your real GDP is around 4%, and 4% real GDP is what most companies grow their revenues, their top line, at nominal GDP, about 4%, which means in order to get 7% earnings growth, you need to get to building blocks that's going to incorporate margin at least flat, maybe a little bit higher.
So given all of that, do you think that the big tech earnings have been cushioning some of the macro news that we've seen? Yeah. How would you kind of characterize the market's response to the headlines, especially of the last week?
I would characterize it in terms of the narrow breadth of the market, that a relatively large percentage of the return for the index, the top line index, is coming from these companies. Admittedly, they're about a third of the market cap of the index, so obviously they matter a lot. That's, I'd say, the key takeaway. And they are, driving a lot of the conversations around AI, around efficiencies, that other companies are spending money. And so those themes are ones that really are capturing most of the investor conversations right now.
Now, is that what you would advise investors to do, is essentially defer to that market message? It's the AI theme driving most of it, or there are other places to look? I mean, you have actually seen cyclical stocks relative to defensive ones hold up pretty well, even though we're talking about subpar GDP and, maybe the need for rate cuts.
So, Mike, the message that we look at, the analysis we look at, is that the cyclicals relative to defensives are pricing, equity market pricing, as though the economy is growing closer to 3%. It's not, but the equity market's pricing as such. So we're concerned on the move in the cyclical stocks, and a lot of the conversation is around the largest companies. And so I think about AI in terms of phases. And so a lot of this move has been in the infrastructure-related companies, infrastructure kind of related to AI, utilities, power companies, some of the semiconductors other than NVIDIA, and focus more on the application software companies, where a lot of the their customers are spending money to try to get the data in a way that they can use and apply AI. So that's, I think about the phases around AI, and that's the phase we're focused on right now.
Anybody else? Anybody for Costin?
Well, I mean,
don't force it. I mean, all right. So what about your targets? What does it all mean?
So what does it all mean? We got the S&P index at around 6,600, about 5% up from now to the end of the year, and about almost 10% to 6,900 at the end of 12 months. So looking out 1 year from today, that's the expectation. That's a reasonably solid return around the idea of earnings growth, David. That's the key. Earnings growth of around 7% this year, 7% next year. It's the trajectory of earnings as opposed to multiple expansion. Stock market trades at 23 times earnings, so it's a really, really expensive, historically speaking, expensive market. And the typical stock trades at 19 times, which is still high, but not as high as and that's the impact of the largest companies in the Mag 7 in terms of lifting the overall market.
Which obviously also have higher growth rates. David, thank you as always. Appreciate it. David Costin, Goldman Sachs. Here's our roadmap for the rest of the hour. After the break, a record high for Palantir. We're going to talk about that company's strong quarter driven by AI. It did push revenues to over $1 billion. That was a first.
Plus, JP Morgan responding after President Trump called out the firm along with Bank of America over so-called debanking of conservatives. New details ahead.
And Google just making headlines on a potentially major advance in AI. That story and much more. Let's go up on the street. Comes right back.
Save $500.
Some news out of Google. Let's get to Mackenzie Segalis. She has the details. Mackenzie.
Hey there, David. So today, Google unveiling a system able to
to generate realistic, interactive environments from a text prompt, part of a long-term effort toward artificial general intelligence, building AI agents that can think, plan, and act without real-world trials. Now, most of the attention has been on incorporating AI into the Gemini app and search, but another corner of DeepMind, the alphabet unit behind some of the company's biggest breakthroughs in AI, has quietly been pouring resources into another ambitious project, building these virtual worlds to train future AI agents. Google Cloud's former chief scientist of AI, Fei Li, is working on a similar approach at a company that she founded last year. But your big model makers haven't put the same emphasis on this kind of research. OpenAI and Meta are more focused on multimodal models that can handle text, images, and video, which could someday grow into something like this, but no interactive virtual worlds just yet. And Google's trying to build all of this while its top talent is getting poached. Microsoft recently hired away 24 DeepMind researchers, including the VP behind Gemini, and Meta's dangling bonuses as big as $100 million to pull in even more. Now, that kind of brain drain raises the stakes for Google to keep projects like this moving forward, since they're meant to be the building blocks for true human-like AI. Guys?
Mackenzie, just so maybe I can vaguely understand what's going on here. A lot of times when you hear these advances and there's these, it may be objective measures of saying, oh, the model performs well on these standards. I gather that's for LLMs. This is something different. This is creating virtual worlds for the purposes of training AI agents, right? So maybe there's risk of a Xerox effect here, but I'm wondering where this is going to get implemented at some point into something.
Well, I mean, that's exactly the question. This is not the flashy side of Google's AI work, but it is a glimpse into the kind of long horizon research that the company is prioritizing, still funding. But to your point, the question is, will they commercialize it and create new products that actually depend on it, that everyone comes to value? And keep in mind, the focus on this is still relatively new. DeepMind spun up this dedicated world modeling team led by former OpenAI researcher Tim Brooks. Back in October, they brought him in-house, placing it alongside Gemini as part of this long-term strategy to develop embodied AI and simulation-based training. And then in terms of how much this business is worth, I mentioned Fei Li, the former Google Cloud employee. Well, her company, World Labs, they're focused on building large world models to give AI spatial intelligence. They launched last year with $230 million in funding at a $1 billion valuation. Really, the question for Google is whether this research eventually turns into products that people value. But at this point, it's just a bet on a far-off future.
Yeah, many of those being laid right now. Mackenzie, thank you. Palantir hitting a record high this morning after a second quarter beat on the top and bottom lines. The defense tech company topping $1 billion in quarterly revenue for the first time ever. That's up nearly 50% year over year. Joining me now, Jefferies analyst Brent Thill. He has an underperform rating and a $60 price target on Palantir. Brent, great to have you weigh in here. I know that you've kind of been dealing on these two tracks when it comes to Palantir. The fundamental performance continues to be impressive. It's hard to make peace with the valuation. What did this new report tell you along those fronts?
I think what it tells us is Palantir is operating at a level in the software industry that we haven't seen ever before. For a company to put up 45% growth and a 45% plus operating margin, no one in the industry is doing this. So every software CEO is taking notice and trying to figure out what is happening. Dr. Karp's announcement to you this morning that he would like to do this with fewer employees and grow 10x the revenue is also a huge wake-up call for all of us that AI is going to take our jobs. And so I think right now we're just seeing a company that we've never seen before in the history of software as it relates to the balance of growth and profitability. And if you put this in perspective, their market cap today is bigger than Adobe and Salesforce combined. And those companies have $70 billion of revenue, and Palantir next year is on 26. Palantir will have $6 billion. So, the market's forward paying for this in a big way. We haven't ever seen multiples at 75 times forward revenue. It's never sustained. We've had 4 quarters of accelerating growth. And so what we've said is that at some point when that growth just decelerates a bit, so will the multiple, and that's the biggest concern. But look, there's nothing to be concerned right now. They're executing incredibly well, and again, I think it's a scary moment for everyone to realize that they think they can grow 10x with fewer employees. Now, they added headcount in the quarter; they were up pretty materially. So we'll see if they can hold court on that. But again, I think we're just seeing basically a story we've never seen, and it's really hard to judge because there isn't anything relatively anything near it to judge it against.
Right, which I guess maybe helps explain why it's gotten to about 400 billion in revenue, because people you can tell yourself any story. I'm sorry, 400 billion in market cap, because you can tell yourself any story about just how steep this curve is going to be and how long it's going to stay that way. The talk about reducing headcount at Palantir while having this stupendous growth is interesting in the sense that you are a little bit concerned about their sales model, right, where they're not really going out into the field with a traditional sales staff and trying to get new clients.
Yeah, I mean, again, this super unique story, which is their deployments and their customers have spoke for themselves. So this is testament to how good their products are, that they don't need a big sales team. On every single call, Dr. Karp has said this repeatedly, that we have a tiny sales team. And he believes in no-stake dinners and golfing on Fridays with clients. He believes in producing a great product that speaks for itself, that then spins the flywheel. And again, something super unique we just don't see across the industry. The one company, Atlassian, started this way, and now they're having to invest in a direct sales team. So I think, again, what's really different are the growth rates, the go-to-market model. And again, this speaks to the testament of how good the products are. We've spoke to many customers, and the customers are very happy. They're increasing their spend. They believe in the product. So this isn't necessarily any hocus pocus in terms of the product not working. This is a solution that works and is being driven, and sales and marketing is being driven by success of those customers rather than the steak dinners and the constant sales interaction, which again is another model that many are using in the industry and are following them.
Yeah, I bring this up not because you mentioned steak dinners and golfing, but I was trying to think of analogs for a stock that had this huge run, in its first few years as a public company. Everyone said it was too expensive all along the way, and that would be Salesforce. Now, it had nothing like this revenue multiple, but certainly on an earnings basis relative to its peers at the time, there was a constant kind of big pool of skeptics out there that said, they can't really grow into this valuation. Is there any kind of rationale to that comparison?
There's been no real comparison. I mean, we've seen through the years, right, during the 90s and 2000s, Siebel and what happened there. We saw Snowflake go to 50 plus times revenue, and then the multiple came back to single digits, and then recouped the multiple, and now is low double digits. We see two stocks right now that are, great companies like CrowdStrike and Cloudflare. They're between 18 and 25 times revenue, but then the gap to get from Cloudflare at 25 times to 75 times in Palantir, there's nothing in between. So there's no cities to stop at in between those multiples. So the highest multiples we've seen, again, most of them have come back because you can't sustain that growth for that period of time. So again, we're not saying they can't do it. We're just saying we've never seen it before. And I think that's a hard thing for many of us that have been doing this for a while. There is no comparison.
Right. Yeah. And we know the company, kind of looks to directly sell itself on an investor relations basis to retail investors. The street's been a little bit of a skeptic all along. We'll see where it goes from here, Brent. Really appreciate it.
Still to come, the new numbers boosting Apollo shares and what executives had to say about a, quote, very, very large market opening up. Plus, big moves in healthcare. Vertex, one of the biggest laggards on the S&P 500 this morning. Those shares down more than 17% right now. We'll break it all down with the head of BMO's Healthcare Research Group. And speaking of earnings, don't miss the CEO of Tanger with his read on the consumer and the quarterly results, helping shares this morning.
now.
Traditional asset managers have struggled with the rise of passive and the decline of active, active being the higher fee, more value-added business. I believe we are watching traditional managers begin to redefine what active management is, rather than the buying and selling of stocks. The addition of private assets to heretofore solely public portfolios. There are lots of examples out there of collaborations, and we are in the beginning stages of this, but this has the potential to be a very, very large market, and most importantly, to serve a clientele that we historically, as an industry, have not had access to. I believe we are on the cusp of being able to serve the 401k and the defined contribution marketplace. I expect there to be significant proposed changes to the regulatory landscape to make this easier. This, to me, is common sense.
That was the CEO of Apollo Global earlier this morning discussing the company's potential move to allow 401k funds access to or greater access to private markets. Shares up about 1% this morning after a beat on earnings, primarily driven by higher fee-related revenue and record origination activity, while core retirement outflows slowed. He was asked kind of what the key impediments are to having greater 401k ubiquity in the private world, and he said the impediments to date have been on some of the embedded businesses, record keeping, technology reporting, kind of archaic things like that. But he says the primary problem has been litigation. This has been a very litigious area where plan sponsors and others have basically been forced to take the lowest cost option rather than the one that produces the best net return. So as they want to see kind of reform, it's on that litigation reform element of it, this idea that, yes, we charge high fees for our products, but we can deliver the returns high. Because that's a fiduciary duty
obviously,
issue for the
one
plans.
of the questions in the past has been, well, what about the lack of liquidity? Obviously, you're not talking about daily liquidity here. Not that you need it for a 401k, of course.
Right. So that's what they would say, is that the kind of duration match is superior there, but there's the lack of liquidity issue. If there is some sort of problem with the fund, can people who are invested in through their 401ks get access to kind of take that money out? Additionally, it's transparency in terms of returns and so forth. But he did say, I don't know the exact number, but it'll be a few $1 billion this year for us of origination into the 401k channel. So that I thought was an interesting number, because again, this isn't something that's illegal necessarily. They just want more regulatory clarity, and they want the plan sponsors who are thinking about this to have a bit more protection on the litigation side as it pertains to their fiduciary duty and paying these high fees for something that may or may not deliver.
I mean, you may not need daily liquidity, but you really do want the NAV to be something close to, what the real value is there. I mean, people borrow against it. I mean, it's,
Right.
So we'll see how, what parameters are placed around that if it happens in a bigger way.
Which we've seen with publicly traded alts in the past, that the NAV trades lower. We saw that with Pershing Square. They had to do a bunch of buybacks to get NAV up.
By the way, that's been a frustration of some people who are invested in hedge funds that invest heavily in privates as well. Sure. Where are they marking them? The Tigers of the world during obviously significant downturns. It's always been a question, Mike, as you know.
Yeah, and that feeds into the realization issue, which is another thing I talked about on the call. The reason we haven't seen so many IPOs of private equity-backed companies is because of that dynamic. They hadn't necessarily all taken the marks when they needed to based on, 2020, 2021 valuations. And so therefore, they're kind of holding on to it, waiting to see, waiting for these companies to grow into their valuations before going public. And that flywheel is important for the realization component for companies like Apollo to be able to distribute more capital back to their limited partners. So that's something that they addressed also on the call, basically saying our peers think there's going to be this kind of rising tide that lifts all boats in terms of realizations and IPO activity and M&A activity, but they seemed a little more sanguine about it, kind of like, we'll wait and see. If we hope our peers are right, but we'll be okay either way.
Right.
All right. Time now for a CNBC News update. Silvana Hanau has that for us. Silvana.
Hey, Mike, good morning. Norway, Sweden, and Denmark announced a $500 million NATO-led initiative today that will supply Ukraine with U.S. weapons. So this package includes Patriot missiles to assist with Kyiv's air defense against Russia. President Trump said last month the U.S. would continue to supply weapons to Ukraine, which would be paid by European allies. The announcement of the package came today as Russia attacked a railway hub in Ukraine's Kharkiv region, killing 2 Local officials say Moscow launched 34 drones overnight, now it disrupted rail service and caused significant damage to the railway infrastructure. And the Coast Guard released its final report on the implosion of OceanGate's Titan submersible in June 2023. 5 people were killed 90 minutes into their descent to view the wreckage of the Titanic. The Coast Guard said in the 335-page report that the implosion was preventable, and the primary factor for the disaster was the company's failure to follow established engineering protocols for safety and for testing. David, I'll send it back to you.
Okay, Solana, thank you. Hims and Hers making a big comeback this morning after an initial plunge in those shares on results. We'll have more on what is driving a volatile morning for the stock there. Plus, President Trump talking about pharma tariffs this morning on Squawk Box.
On pharmaceuticals, we'll be putting a initially small tariff on pharmaceuticals, but in 1 year, 1.5 years maximum, it's going to go to 150%, and then it's going to go to 250%, because we want pharmaceuticals made in our country.
We'll discuss what companies could be impacted the most. That's when Squawk on the Street returns.
For certain.
Shares of Hims and Hers Health making a big comeback this morning after initially slumping double digits on earnings. Let's get to Brandon Gomez with more on what's moving this one, Brandon.
Hey, Mike. Yeah, Hims bouncing back from session lows. Shares were down as much as 13% after a mixed quarter. Let's start with the good, and we'll get into the bounce back in just a second. EPS beat 17 cents a share versus the expected 15. The company reaffirmed its full-year outlook, not to mention the company's long-term game. CEO Andrew Dudum saying on the call that he is reiterating a bold 2030 target of $6.5 billion in revenue. But investors who were already watching for signs of slowing growth dialed in at first on the short term. Revenue for Q2 missed the mark. Both GLP-1 and core revenues slipped quarter over quarter, and Q3 EBITDA guidance came in soft. Now, I spoke to the company's CFO yesterday ahead of the call about that. He told me the company plans to reinvest in growth initiatives, namely focused on talent acquisition costs in tech, spending more in Q3 on marketing within weight loss and other specialty products to overcome some of the seasonality headwinds. Now, you add to that some more vague warnings around regulatory risks tied to their compounded weight loss drugs. And as far as fundamentals are concerned, the growth story gets a bit shakier. Bottom line here, Mike, long-term vision is intact, but near-term execution remains under the microscope. As for the bounce back that we're seeing this morning, this stock is heavily shorted with a 33% short interest. No real catalyst for the rebound that I can see beyond that. Shares, I think, are down around 3% now.
Yeah, usually it is just technical like that. Brandon, thank you. Still ahead, Vertex at the bottom of the S&P 500 today. More with one analyst who says buy the dip after a break. And as President Trump's tariffs take effect, various industries are sharing, in their own words, the impact on their operations and their bottom lines.
Typically, Halloween items arrive in August. For the time when the tariffs were at 145%, it really disrupted all of the supply chain from China. I would say by the middle of September, you'll start seeing shortages because those larger retailers will have to rely on the inventory that is in the United States right now. There's a number of products we weren't able to bring in because they would be exponentially too expensive. 30% I now have to pay to the government, and that is money that could have went towards bringing in more products. Every day that they sit there, we are incurring storage fees, and the warehousing companies are well aware of the situation, so there's a lot of price increases, and then those costs get to a point where it's just much too expensive to sell them, so we might have to scrap. This has definitely been a large roadblock to the growth that we were experiencing prior to the tariffs. It is a Friday Halloween, so I do expect consumers to come to the stores. I don't think they will buy as much, but I do think that they will still continue to purchase and celebrate the holiday.
wealth.
August and September have had a history of underperformance in the stock market, but are there certain sectors or types of stocks that could buck the trend this time around? We're going to speak with one expert who's looking at places that may be relatively immune to downside volatility. Tune into our Market Navigator segment later on today on Power Lunch to find out where they may be, 2 p.m. Eastern Time.
Welcome back to Squawk on the Street. Healthcare, the second worst performing sector this year, and one of just 3 in the red since January. That's thanks to big drawdowns for the health insurers, with names like Centene and United Health cut in half over that time.
But Pfizer shares are gaining this morning, up nearly 5% after beating earnings estimates on the top and bottom line. The company raising its full-year earnings guidance. Joining us now is BMO Managing Director and Head of Healthcare Research, Evan David Siegerman. Thank you for being here, David. So they hiked their forecast despite President Trump's calls to lower drug prices, as well as tariffs on pharmaceuticals imported into the country, potentially more tariffs to come. Do you think these policies are variables that could ultimately change that outlook?
Well, first of all, I think Pfizer typically has pretty conservative guidance at the beginning of the year. Remember, a few years ago, they had to cut their guidance. They don't want to do that again. So I am encouraged with the progress that we're seeing in the first half of the year. Of course, raising earnings raising full-year earnings is great. And I think that they are factoring in these potential tariffs. Obviously not good for the sector, but I think they're managing them well.
What were some of the key drivers in the quarter from their drug assortment that helped lead to some of the revenue growth that we saw, and what were some of the detractors that concern you?
Well, first of all, they are doing a really good job at expense management. That's one of the key initiatives by CFO Dave Denton. He really believed that the expense base was too great to support the revenue base that they had. So he's done a really good job of cutting expenses. And beyond that, key products like Vyndaqel, Eliquis, Padcev, some of their main growth drivers are also doing very well. So that really creates a great setup in the back half of the year.
On the flip side, we have Vertex, which said it wouldn't move its pain treatment into further testing. Was this a surprise to you? The market seems like it is.
This was a surprise, and looking at the reaction, we are actually in the red for the year. It was one of the best performers in biopharma. I think a lot of investors had hoped that they were going to build on their currently approved asset, Jornavix, in the pain space, but this phase 2 trial really didn't show any efficacy, and it's a kind of back to the drawing board to figure out what's next in their pain portfolio.
Yeah, that's what I was going to ask, kind of what does happen next, and particularly as it pertains to pain management.
Right. Well, they are selling a drug called Jornavix in the acute pain space. They do still have a trial going on with this next-gen asset. But when we spoke to management yesterday, they are looking at earlier development products to potentially move those forward. But there was a lot of question marks just around, what's next. And unfortunately, I think that's what's driving the reaction. You have uncertainty from management, and, that uncertainty spooks the market.
David, just coming back to the Pfizer, Merck kind of setup here, the market's treating these as kind of runoff business. It's like 8 times earnings. Are people just afraid of the fact that earnings power is going to be lower persistently in the future, or is there actually a value opportunity here?
Well, I think when you look at Merck, for example, you have a big LOE with the Keytruda franchise. That's a potentially $30 billion franchise that's going to have biosimilar competition by the end of the decade. So that's a big issue. We don't have assets that are going to replace that and allow them to grow. When it comes to Pfizer, they have similar issues with LOEs from Eliquis, Xtandi, Xeljanz, for example. It's more of a death by 5 cuts versus 1, but they still need to invest and create new assets and grow them to grow the business, and that's where the concern is coming from.
Yeah, Evan, I mean, you look at 20 years of Pfizer and you get nothing in terms of the performance of the stock price.
Right.
They spent a lot of money on Seagen. What are we seeing there, or what are our expectations in terms of perhaps contributing to that growth you're talking about?
Well, I think Padcev is a really interesting growth asset. Back when they acquired it, there was some really good bladder data. They're leaning into that. We've actually been a little disappointed, to be honest, with Seagen. There's a lot of interesting assets, but when I ask them about what's really important, aside from Padcev, I don't get a clear answer. So we're waiting to see what that looks like. And yes, that is a bit of criticism, and I'd love to really understand what's exciting them more and for them to be more clear.
Yeah, certainly a dynamic space these days. Evan, thanks for joining us today.
Thank you for having me.
When we come back, President Trump calling out J.P. Morgan and Bank of America over perceived bias against conservatives. What the banks are saying in response is next. And don't forget, catch Squawk on the Street anytime, anywhere. Listen to and follow the Squawk on the Street podcast. We are back in a moment.
For certain.
Welcome back. The Wall Street Journal reporting that the Trump White House is preparing an executive order to punish banks over perceived discrimination against conservatives. President Trump was asked about the so-called debanking issue earlier on Squawk Box.
They did discriminate. I had J.P. Morgan Chase. I had hundreds of millions of dollars in cash. I could see if they want to, if they want to do something bad because you don't have any money and you're defaulted and they took people out, but I'll give you me as an example. I had hundreds of millions. I had many, many accounts loaded up with cash. I was loaded up with cash, and they told me, I'm sorry, sir, we can't have you. You have 20 days to get out. I said, you got to be kidding. And then what happens is I call up Bank of America routinely because when I was president, this was after I got out, by the way, I call up Bank of America routinely, and I speak to him, and I speak to a couple of people, and they have zero interest. Brian was kissing my ass when I was president, and when I called him after I was president to deposit $1 billion plus and a lot of other things, more importantly to open accounts, which banks always like. They like accounts because they get interest-free, you know, the overnights and things, there are a lot of reasons for it, but they like accounts. I had hundreds of accounts, and he said, we can't do it. No, we can't do it.
Bank of America CEO Brian Moynihan will be on Power Lunch later today in the 2 p.m. hour with Andrew Ross Sorkin. Look forward to his response there. In the meantime, we did receive a response from J.P. Morgan, which says, quote, we don't close accounts for political reasons, and we agree with President Trump that regulatory change is desperately needed. We commend the White House for addressing this issue and look forward to working with them to get this right. A lot of this, guys, boils down to the issue of kind of regulatory opacity over who banks can have as customers and not run afoul of certain anti-money laundering rules and and know your customer rules. And so indictments and individuals who have been indicted is one of those kind of gray areas that they would get concerned about. There's no hard and fast rule necessarily that they can't bank indicted individuals, but it's something that, you know, if they want to be conservative, if they want to be prudent, they may say, you know, unfortunately, we can't bank you, we can't provide services to you as a result of all of this. And so, given President Trump was indicted following January 6th, perhaps
he was
that's
indicted in a lot of different places, but he was only convicted in one,
right,
in New York. Don't know if that was the reason.
And my understanding was that it was the indictments alone that were enough
to trigger that in terms of what he was discussing.
Well, there was also talk when this issue was sort of surfaced by the White House months ago that, you know, you mentioned it's a gray area and you may have regulators, you know, either explicitly or not telling banks, you know, err on the side of don't take a certain kind of business, not that it was a decree.
Exactly. And so crypto is one of those areas where historically banks have not quite been sure what to do about that, and whether it's to bank crypto companies or people who have gotten wealthy off of crypto or whatever it is. And so that's, you know, that's an example of that. But they may also be conservative. They may also be you know, religiously affiliated somehow. So oftentimes there are a bunch of different variables at play.
And a lot of talk about how that's sort of behind, you know, the Trump family's interest in crypto, really, and their big push into it. You know, they found themselves without other, you know, traditional places to go.
Right.
They found a lot of places to go now. Mike, I mean, we are seeing kind of significant weakness in banking. Any thoughts beyond what we heard from the president?
Well, first of all, they were up big yesterday. I think it was the ISM services number. Which, you know, and we get this whipsaw because you get the kind of the services PMI at 945, and it looked like it was actually an upside surprise. We rallied on it, and now we've come back in. Yesterday's action was very much, I think, just sort of this, a little bit of an instinctive impulse to buy the dip. A lot of the retail-focused names really running. The big NASDAQ stocks, again, you know, was sort of like a muscle memory type of thing. And now, you know, we're sort of in the range we were between Thursday and Friday.
But to your point, it is worth noting we have, you know, we've turned around significantly on the session as a result.
Yeah, we keep changing the story from the economy strong enough to deal with no rate cuts to, oh, no, maybe we'll get a rate cut in September and therefore we can make it through this soft patch. So the bulls keep telling themselves sort of a different narrative depending on the day.
Bad news is good news. Good news is bad news.
Depending.
Good news is good news. Bad news is bad news.
All right, Mike, thanks for being here, as always. Mike Santoli. Coming up next hour, the CEO of Honeywell. We're going to get his read on demand on tariffs, of course, how AI is changing the business of that company. Join us when Money Movers begins. That'll be after this quick break.
Peacock.
Grown up.
Order filled.
Now.
Order filled.
AC Plus.
Order filled. Order filled.
Nine.
All right, David, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The state of stocks, the economy once again in question, and the markets entering a historically rocky period. We'll debate the best ways to play the markets with the investment committee. Joining me for the hour today, Josh Brown, Joe Terranova, Anastasia Amoroso, and Jim Lebenthal. We will check the markets. We're trying to build on yesterday's gains. We started out that way. We did reverse, though. Some of the economic data today wasn't great. It was a miss on the ISM services. There's the S&P down almost 0.5%. So, Josh, I'd love to get your take on where you think we are. HSBC today raises the target for the S&P for year-end to 6,400. They say their bull case is 7,000, mostly because of AI-fueled optimism. We did have that below expectations ISM report. We're coming off the weak jobs report and the revisions. What say you about where we are?
Well, if we're going to get to 7,000, it's going to be because of the AI build out. That is the only pillar holding up the U.S. economic growth story right now. Consumer spending has ground to a halt. The gains that we had been experiencing in the labor market for the last couple of years, despite higher rates, are now grinding to a halt as well. You look at ISM, really not a lot of great things in the commentary outside of CapEx spending, electrification, grid updates, all the things that we all already know. And I think that's okay because the stock market and the economy are not the same thing. I wouldn't suggest that they can diverge forever, but certainly we could live through a period where everybody just gets accustomed to a slower pace of economic growth and services growth, and things are good, not bad, but certainly not at the pace that they were in, let's say, 23 or 24. And I think that's where we are. That being said, the companies that comprise all of the market cap in the S&P 100 and certainly the NASDAQ, that's where the earnings growth is happening, and it's almost happening sort of on its own timetable and on its own track. So I think all of these industrial stories about grid build-outs and data center build-outs, like all of that is going gangbusters. You can't deny it. You hear it on every single call. Everything that has to do with cloud computing and data center, it's on fire. And is that enough is really the only question. And will the consumer hang in there until we get a growth driver for them? So I'll finish this by saying there is a growth driver out there for the consumer. It's when the Fed starts to cut rates, mortgage rates meaningfully change, and all of a sudden we get a little bit of life back into the cadaver that is existing home sales, and we start to see a housing cycle. I don't know if that's at Fed funds 4.5%. It's probably lower than that, but that's the big thing out there that will be a game changer for the middle class and to see a resurgence in services spending. Until that happens, you really have to rely on mega cap tech and the industrials that are benefiting from the CapEx numbers they continue to ratchet higher. It's okay. We probably can, not definitely, but if you're rooting for a great finish to the year and a 7,000 S&P target, that's the only way it's going to happen.
Yesterday, Joe, smacked of rate cut optimism. The market was up big. You got the Dow getting all of its Friday losses back. The Russell was the outperformer, the thing that would jump the most if you were obsessed about getting more rate cuts than you thought just 1 week ago. Today smacks of bad news is bad news. I mean, here we are wondering, okay, what is the state of the economy? What's the Fed going to do about it? Can they even do anything about it? So we're in a historically choppy period. August is a nothing burger in terms of performance. July's always pretty good, and September seems to be pretty bad. And here we are in this period of time where we have significant questions that need to be answered.
So you have to set an expectation. I think that expectation relies on being somewhat patient here. You're going to have to be patient towards the end of the month. Will Jackson Hole be the moment in which the Federal Reserve telegraphs that a rate cut is coming in September, which I agree with Josh will have a positive effect on, most importantly, the wealth effect. It will stimulate the housing market, and that's important right now as a catalyst. But until then, look, I'm just looking at a chart over the last 2 weeks, and you can see clearly the last 3 trading days, we've had an expansion of the bars. We've had widening of the trading ranges. It's elevated volatility. It's classic August environment. And in that type of choppy environment, to borrow the word that you're using, I think it's important that you understand your position sizing needs to be small, because I don't think we resolve this big question surrounding Fed rate cut or not until the end of the month.
Yeah, Anastasia, I'm not sure the market really is convinced of anything. You know, Gundlach told us yesterday when we talked to him, he thinks 2, maybe 3. But I'm not sure the market really can make up its mind as to when it thinks it's going to get cuts. There are some firms on the street that still think you won't get any, right, because inflation is going to remain above target, and that's going to be the concerning factor for the Fed, even if the labor market continues to look a little more dicey. Now, there is a decidedly different point of view that says labor market, they're going to err on the side of caution first. And the first real sign, now the revisions notwithstanding, that they're going to cut rates because they're not going to wait around.
Look, I agree with that sentiment, Scott. And when you think about what Fed Chair Powell said last week, is he really talked about the one-off increases in inflation due to tariffs being a one-off. He talked about, looking at the 1 year and beyond inflation expectations and really not seeing much in terms of higher inflation expectations over, let's say, a five-year period. So I do agree with you, Scott, that he really cited the labor market weakness as something they're cautious about, and they do see downside risks that are also apparent. So to bring it back to the point of market choppiness, I agree with the sentiment here. This is a choppy period of time, and I think this is a quarter of adjustment to higher tariffs, which is now everyone's base case. And at the same time, also the quarter of adjustments to lower rates. And I think we'll see this sort of price action because some days we're going to react to the fact that, for example, Caterpillar had to take 1.3 or 1.5 billion hit to earnings because of tariffs. So we have to price that in, which means lower margins. And on the other hand, when you do get a services ISM number, which is weaker than expected, you start to ratchet up the rate cuts. So the base case for me is choppy price action until we get to that September meeting, which is not until September 17th.
You still feeling a correction's coming?
I'm going to change the term because correction is down 10%. I don't think we'll get 10%, Scott. I do think we'll get that full 5 to 7% from the high. And I don't think that's much of anything. I think it's going to be catalyzed by exactly what we're talking about today. The ISM services miss. I said this yesterday. We just can't afford it in this environment. And who knows? The next kind of macro data that I'm looking at is Thursday's jobless claims. Those have been very quiet. You just don't need a spike there. That's the sort of thing that could move the market lower.
Didn't you really zero in on today's number yesterday?
Yeah.
You said it was one of your focal points, given that we're 2/3 of a service-based economy.
And frankly, I'm surprised we're not down more. I am. But there are reasons, there are positives out there. I mean, let's not forget that GDP is growing. Now, many of us will say, yeah, that's because of inventory adjustments. That's because of trade fluctuations around tariffs. But GDP is still growing. More importantly, profits are growing. Second quarter earnings are now looking like they're solidly in double-digit year-over-year growth. Remember, that was expected to be around 4.8% as we started the quarter. Why does this matter? It matters because if profits are growing, companies don't want to lay people off. They're clearly not hiring. We see that in the continuing claims, but they don't want to lay people off. If they can just get more crystallization about what the tariff picture will actually be, then they can lean in, particularly when the Fed cuts rates. I'm going to come out and say this. I definitely think the Fed's going to cut in September. A little bit more provocative. Joe, I get your point. I just don't think the market needs to wait to accept that to Jackson Hole. I think the market's accepting it now. That's why it's not down more.
Well, we'll see. It may want some confirmation, and it may get it at Jackson Hole if the chair uses that platform to set the table. I want to move and talk about the stock of the day because it's Palantir. And it is at a record high after beating on earnings, surpassing $1 billion in quarterly revenue for the first time ever. The stock has just ripped. We've mentioned it on so many occasions because of what's happened in the high beta universe, where most of those stocks have ripped. But this is the one that investors have continued to zero in on. Yes, valuation might be high, but you know what? Performance is high, and it remains that way, Joe. When you doubt it, it smacks you in the face and says, we can do it. We can do it. We can live up to this high expectation.
These are staggering numbers. Fundamentally, when you combine the revenue growth with the margins, I know the rule of 80 is coming into play here, the combination of that, but they have delivered here beyond the expectation, and the expectations were obviously and needed to be remarkably high. I do think, and I mentioned this yesterday on the show, the analyst community, surprisingly enough, really wasn't embracing the type of price action. There was skepticism there. The 12-month price target was $116. We've got a lift in that today to $142. So look, quite candidly, I'm relying on the rules-based nature of the ETF strategy, which has been in the position since January of 24. There is no way, if I had discretion over the account, I would have kept us in Palantir for the entirety of 900+%.
Well, look at the move.
Higher.
Let's go back. Let's go. Show me the chart prior to one you just put up. From the April low until right now is extraordinary in and of itself.
Absolutely. And listen, when we declined in April, I was at that point saying to myself, okay, this is a shakeout that could take this stock back down to $50 or $60, and I was wrong there as well. So I'm relying on the rules here to keep us in the position, but you have to credit this company. They are absolutely delivering on all the fundamental metrics. So if you're skeptical here and you're just blaming price, if you're saying, no, this is just a representation of momentum, it's the reason why, and trees don't grow to the sky, it's more than that. It is actually delivering on the fundamental AI story.
Not all momentum type names are created equal. Deutsche Bank, to Joe's point about the analyst community not necessarily buying in, so to speak, Deutsche Bank throws in the towel today. They had a sell call on the stock. Current valuation still challenging, they say. Can't wrap our arms around that, but our conversations with multiple customers in the company over the past several months have further reinforced the view that something special is going on here. That doesn't underscore the really? I don't know what does. So they're at hold. They can't bring themselves to buy it because of the valuation questions that they continue to have, but they have taken it off of sell. Josh Brown, why know you here? Why don't you own a name like this?
So we have exposure through the S&P 500. This was added on September 23rd. I'm one of these idiots that's worried about the valuation the entire way up. And I don't always do that. And in this particular case, I just absolutely missed. I missed on the story being as powerful as it is fundamentally, just purely in terms of the growth. This was never a cheap stock, all right? So it's up 124% year to date. Even at those April lows that you just put the chart up, there was no opportunity. It was never selling at any sort of a discount on price earnings growth. Just literally never. And this is a hallmark of some of these classic growth stories where they just don't let you in if you're thinking with 1980s or 1990s brain, because that's not what's moving the stock. What's moving the stock? They have signed almost 1,000 customers. Forget about all the government contracts, which are, of course, huge and a major part of the story. Alex Karp spent a lot of time in his remarks talking about the business customers, the commercial customers, and commercial revenue was up 93% year over year to $306 million. The government revenue only, I say only with air quotes, rose 53%. So a lot of people are looking at this like a defense contractor, but in fact, their commercial business is growing at double the rate on a year-over-year basis. Now, they're guiding to $4 billion in revenue this year, which is great, but the market cap is $400 billion. So it doesn't make sense where the stock is trading, but I understand it. I listened to the call. Alex Karp is the new Elon Musk. Yeah. He's downright messianic. He comes on the conference call, and one of the first things he says is, sorry to the haters. The new class of investors, they love that. They care more about that than anything a sell-side analyst who's accustomed to covering Lockheed Martin learned in business school. So that's the component of this that I missed. Not only are they executing, they're doing it with swag. That's what investors want. And you look at growth managers who are not in this name, and they have a mutual fund with 200 positions, and Palantir is not one of them. You ask yourself, who the hell is buying this stock up 7% today after this huge run? That's who. I don't have to do that for a living, thank God. But a lot of people do, and that's where that buying pressure continues to come from.
Karp's the kind of guy who he kicks your you-know-what, and then he gets in your face afterwards, and he tells you that he just did that. And I mean that as a compliment.
Look what he just did.
Clearly the market
can't
does,
argue
and
with
investors
it.
seem to let.
By the way,
I'm not arguing with it.
Karp doesn't set the valuation. Karp manages the business. And this company, with a rule of 40 score of 91 or 92, you can't make a chart of that and put other software companies on the same chart. The scale, they wouldn't. So what he's doing is amazing. He doesn't decide the market value is going to be $500 billion on $4 billion in revenue. That's not up to him. That's what investors have decided.
Right. There are, if you want to use air quotes, we can put it around culty stocks. Maybe this has entered that universe like Josh was talking about regarding Musk and Tesla. Do you see Lemonade, guys, today? In terms of, if you want to say some of the, and I'm not putting Palantir into the lower quality category by any stretch of the imagination, but meme-like names. Lemonade, surging today, up 29%. There's Axon. Joe owns that. It's the old Taser. That hits a record high. There's a bit of that going on there, too. Yes, they raised their guidance. Their earnings beat. The target goes to $9.15 from $8.75 at Wolf. It was on Josh's best stocks list on June 17th. It's up 13% since then. It's been in the Joe T for how long?
1 year. So we purchased the stock at the end of July last year at $300. We've stayed in the stock. They've delivered on the earnings growth. This is public safety equipment, and there is a degree of cult following here, in particular in the law enforcement community. So they understand the technology, they understand the purpose of the technology being utilized, and keep in mind, as municipalities continue to be strained in their budgets and you see staffing issues for law enforcement, you're going to be relying more and more on the technology. And this company is delivering that technology, and along with delivering the technology, they are delivering the earnings growth and growing into what several quarters ago was an obnoxiously extreme valuation.
Look at the chart.
But now you're seeing the growth and that valuation. They're slowly growing into it. Still triple digits, but slowly working their way into it.
Give me an intraday on that, too. I mean, the chart from last fall until now is like, wow. I mean, you literally...
There's three stocks in the market like this. There's Palantir, there's Axon, and there's AppLovin. And those have been the three quote-unquote momentum names that actually, though, have been supporting their price appreciation with some actual revenue
Give me
growth.
Joby, too, guys, if you would, please, because the news was yesterday, of course, about the acquisition of Blade. Yes, the stock is down today. It did hit a record high yesterday. Shares are up 200% in 3 months. Our Josh Brown just talked about that in the last couple of weeks as he owns it. What do you think?
Yeah, so this is not on the best stocks in the market list. Highly speculative. Let me give you an example. They report earnings tomorrow. They're expecting revenue of $60,000. So the good news is that's up 113% year over year when they reported like $20,000. But what's happening here is really unique. I have a small position. I'm up substantially in the stock. I'm going to hang on to it. Buying Blade makes perfect sense. Blade is going to now rebrand. They're going to keep this medical evac thing that they're working on, and all of the consumer rides like booking helicopters and short hop routes. Those will come over to Joby, which makes sense because Joby is going to have the aircraft itself, which Blade does not have. So it's a really smart deal. But when you look at the news flow with Joby, this whole sector is just so red hot right now all over the world. And I don't know when we're really going to see like the hardcore commercialization of electric vertical takeoff and landing, like in a city near you. But they're working on it in the Middle East, and they're working on it in California, and everywhere in between there are opportunities. And I think Joby is in pole position to really have like the most market share, the most mind share as this stuff starts to commercialize. So very speculative. I never tell people to imitate what I'm doing here, but I am keeping my position, and a lot still has to happen in order for this to be a long-term successful company.
Stock's definitely taken off. See what I did there?
You did.
You're listening?
Anastasia. Look at you, vertically taken off.
Yeah. What do you think about these moves in these types of names? You can put them into whatever category you want. You don't necessarily have to put Palantir in there. But the meme stocks, the cult stocks, the low quality stocks, the high beta stocks, concerning to you in any way when you look at some of these charts?
I mean, yes, near term, but at the same time, I think the question that was flashed on the screen, and Scott, that you're asking is whether there's still more room for those high beta stocks. And I do actually think so, because first of all, the cyclical environment is slowing. And what do people do during that time? They look out for that secular growth. And that's exactly, I think, why we're seeing some of those names outperform.
I'm not even asking you whether there's room to go. I don't even think that's the question.
Whether it's justified, you mean?
Well, I mean, it very well could be. I don't know. I mean, does it give you any kind of pause of a speculative fervor as part of this market that makes the quality of it, or at least the durability of it, in some kind of question?
Well, I would answer it looking at the aggregate valuation levels. Whether you look at Palantir, whether you look at the S&P 500, we've come a long way in a short period of time. So I think there's definitely something there. But at the same time, Scott, has it been justified? Whether by getting the trade deals done, whether by having the AI momentum, I think it has been justified. And the other reason why I say some of this can further be supported is I do agree with Jim that we're headed for a September rate cut. And so if that's the case, that could further fuel some of those valuations. So near term, maybe I would be looking for a consolidation, but I think there's some momentum. I will say, Scott, just really quickly on Palantir and the AI momentum, it is very clear we're early innings, and I think you want to stick with those stocks, but probably be really mindful of valuations there.
Jimmy, you need one or two of these in your book.
Yeah.
I mean,
so
come on,
here's
What's going on with you?
Well,
live a little. Have some excitement in your life.
Bring back the Roku trade?
I mean, why not? Every now and then you have a hunger for this.
So here's the serious answer. It's a good question. What do you do here if you're me and you actually do pay attention to valuation? It was funny when Josh said if you have a 1980s, 1990s mindset. I'm not so conceited to think, Josh, you were talking about me, but I felt it. Nonetheless, here's what you do.
No, me. Talking about me.
It's okay, Josh. It's okay. Well, here's what you do. You wait for your spot, and it feels uncomfortable right now. But bear this in mind.
Palantir?
Just hang on a second. Hang on.
I don't know.
Okay.
I think
Adam
you need
Parker,
to put the glass of white milk down and grab like a brown spirit or something. Live a little. Come on, Jimmy.
All right. Our friend Adam Parker did a study on this on the last year, and it's really good. If you have a 10-bagger like this, and you know what else is? This is relevant to NVIDIA over the last 5 years. You have to be prepared that there will be pullbacks of 40% or more. Now, there will be a pullback in this name. And Josh, you said it. It's, if you're looking for the way in, it's not giving it to you right now. Believe me, I feel that. You got to be patient if you're not in it here. Buying it at this level seems tough to me. Just wait for the inevitable pullback. I'm not going to wait for a 40% pullback, but something comes down 10, 15%. I'm telling you, this looks like NVIDIA 5 years ago. I eventually got into it, Scott. I did. And I've had great returns, but I wasn't Josh Brown. I feel bad about that, but only Josh is Josh.
To defend Jimmy, and I sincerely...
we're just ribbing him.
No, I know, but listen, human beings are not programmed to manage that type of volatility. Human beings don't have the ability in an extreme environment where you're seeing triple-digit gains to think about valuation, to think about strong price appreciation, to think about elevated volatility, and to ride through declines of 20+% or more. There are people out there on X that think they can do it. They can't.
Absolutely right. Absolutely right, Joe. And look, I mean, I don't want to call you out. I'm not. But you said something and I caught it. No, you said, listen, if it weren't for the rules-based process, which serves you extremely well, you would have been out of this 100%. A long time ago, right? Fundamentally, this is how I take that. Fundamentally.
One way to do it, though, is position size. Like, we talk about all these risk management methodologies with options and this and that. But, like, saying to yourself, you know what? Palantir at $250 billion is totally stupid, but what if I'm wrong? I will buy a quarter of a normal allocation. I didn't do it, so I'm just spitballing here. But this is what I've done with stocks like Joby over the years. I did it with Toast, and then as like things develop, it's like, all right, at least I'm already in lower, and I can average up. But I don't feel like a complete clown buying an all-time high. So position sizing is an underrated way to get comfortable with high growth, high momentum situations where the valuation is stupid.
Be quick.
Josh, I totally agree with what you're saying. The problem that I personally have is if I buy that toehold and it does go down 30%, whatever number, and you know this, right?
That's loss.
I've got clients calling me and say, why did you buy at that price when you, Jimmy Lebenthal, are so valuation oriented? I just can't.
Did you get those calls with Roku?
Yeah, well, okay, all right. So, I mean, that's what we're always going to go to is the.
What do you mean? It's the most relevant.
It was a total aberration.
Did you get those phone calls,
Scott?
down?
I shouldn't have done it, but it was so obvious that I just did it, and I haven't done it since.
Did you lose money in it?
No.
Then what do you mean you shouldn't have done it?
Because I wasn't true to myself. What do we have to have a psychotherapy session here?
Jim, let me move a couch over there. You lay down. I'll charge you for 50 minutes. We're already over. I can't even get 50 in. It would be good. All right? You hold on. We'll take a quick break.
I shouldn't have done it.
We do have more of the day's biggest earnings movers. We'll do that next. Our call of the day. Later, Josh Brown has a new addition as well to his best stocks in the market list. Halftime's back in 2.
App today.
All right, let's do some committee stocks on the move. We're starting with Vertex today. It is sinking despite beating estimates. Is this Joe Terranova time? Joe?
For Vertex?
Who has Vertex?
Vertex.
Yours truly.
Really?
Go ahead, Jim.
Don't act like you didn't know. Yeah,
I was trying to let you breathe a little bit.
Yeah, okay, breath is over.
management platform, weight loss and diabetes drugs known as GLP-1s. Yaccarino calls the new job a chance to redefine an entire industry. Scott, I'll send it back to you.
All right, Silvana, thank you very much. Silvana, now coming up, Josh Brown's best stocks in the market. He is ready with a new addition to the list. The big reveal is next.
Us.
It is Josh Brown's best stocks in the market time. You added a new name. What is it?
That's right, Scott. Today we're going to talk about Dominion Energy. Ticker symbol is D. If I ask most people what they think is the most important geographic location on Earth for the modern internet, they'd probably say Silicon Valley. Some might say somewhere in Asia. They would be wrong. It's Loudoun County, Virginia. 70% of the entire world's internet traffic passes through that area, and Dominion is the electric utility that is responsible for the bulk of what needs to happen in order for that 70% of global internet traffic to come alive. Story here is very simple. When the consumer internet was born, this is where AOL was based. And from there, Yahoo and ultimately Google, Amazon invested $52 billion between 2011 and 2021 right in this area of the country. They've just committed to spending another $35 billion between now and 2040. Amazon's putting up another 42 million square feet of data center space in the region. So Dominion is the company supplying the bulk of the electricity needed. They just said that of their top 10 all-time peak electricity demand days in the state of Virginia, 9 of those 10 have occurred this year. So that's what's happening with the company. You look at the stock price. What makes this a best stock is when they reported earnings last week, they affirmed their dividend for the year, their earnings outlook for the year, and their creditworthiness. And this is sort of, I don't want to call it defensive, but it is a utility. But you've got a stock. Give me like a 1-year chart, guys. You've got a stock now about to break out above historical resistance at about 60, 61, happening as we speak. You've got that moving average crossover that I just live for. I'm obsessed with this golden cross that we're showing you here, the 50 above the 200. And there's a rate case that we should get results from in September. That's the next catalyst. They have submitted to their regulators the case for why they should be able to increase rates, obviously serving all these data centers. If they get it, if the regulators say, yes, here's your new rates that you can charge, that's the catalyst that I think takes the stock higher. From a risk management standpoint, I would use 50 as a trader. That would be my pivot point. Breaks below that level, something must have changed, and we'll find out eventually. So long as she stays above, I like it here.
What's interesting...
4.5% yield, PS. 4.5% yield.
What's also interesting to me is trying to, and it sounds like you're trying to as well, everybody kind of is, wrap your arms around a new way of viewing these types of stocks. What was a historically and classically defensive type thing of utilities is now like a new growth stock. It is.
It's a new oil portfolio.
It's crazy, but they're look. You've got the bulk of the people who have owned this stock for the last 10 years own it because it's a regulated utility. It's one of the top payers in the S&P 500 dividend wise, and that's the traditional shareholder base. And over the last year, that's changed because people are recognizing there is no AI without electricity. And the demand goes higher, the rates that can be charged go higher. And it's not just rates, it's this entire build out that only a small handful of companies are capable of managing and executing. And this is one of those.
What do you think about this space?
I think Josh and the conversation here is spot on, which is this is a new growth stock. I mean, you look at utilities, for example, they're up just 8% since the beginning of June. And I think it's the realization that hyperscaler CapEx is actually once again reaccelerating, surprising to the upside, which means more data centers and also more energy needs. And speaking of energy needs, the reason why I think investors are waking up to this being a growth story, Scott, is because we have not seen a lot in terms of power generation growth and really demand for electricity growth until just a couple of years ago. So I think this is a secular trend and sticking with it.
You just added Atmos, which is a new utility buy in the ETF.
Really love that we added this to the portfolio. This is a stock that technically looks phenomenal. Look what it's done over the last 5 years. It's up nearly 50%. It has been really strong recently, and it is the solution as it relates to power generation data center demand. Natural gas is going to fill that void. These utility companies are the new oil.
All right, coming up, we have a CNBC exclusive interview. We're live in Aspen today. Andrew Ross Sorkin standing by with the former Treasury Secretary, Steven Mnuchin. We're back right after this.
Welcome back. Let's get out to Andrew Ross Sorkin now in Aspen at the Economic Strategy Group meeting with a special interview. Andrew.
Hey, thanks, Scott. We've got the former Treasury Secretary here, Stephen Mnuchin, of course, the founder and managing partner of Liberty Strategic Capital as well. It's nice to see you, sir. We got a lot of former Treasury Secretaries. Hank Paulson's here, Tim Geithner's here, Larry Summers is here, you're here, Bob Rubin, Janet Yellen. Who am I missing?
It's a big turnout.
Here's what I want to talk about. Tariffs. We talked to the President of the United States this morning on tariffs, on these investments that are being made by our trading partners into the United States. When we heard from you, I think this was back in April, you said you thought 10% tariffs would be okay. The markets would tolerate that. We're not anywhere close to that right now. What do you think's baked into the way the markets are actually thinking about tariffs today?
Well, first of all, it's great to be here with you and a terrific turnout. The president has two objectives. One is to rebalance the trading relationships and to make them more equal. And that's something I completely support. That's something I was very involved in with the first term in both China and USMCA. And the second is he fundamentally believes in tariffs for creating revenues. I think if you did a 10% baseline tariff across the board, you'd raise a lot of revenue. If you could score it, I think people think that's in excess of $2 trillion over a long period of time. And that would have a meaningful impact on the budget deficit. I think right now you see he has tariffs somewhere between 15 and 30%. I'm glad to see the EU is done at 15. I'm glad to see he has Japan. Looks like they're making progress on China. So I think the market is slowly adjusting to what will be a higher baseline tariff across the board.
Slowly adjusting. The market has not really moved. In fact, it's just continued to move higher for the most part. And so the question is, do you believe the market fundamentally believes that these tariffs are here to stay?
Well, look,
at these kind of levels?
There was a big correction in the market after Liberation Day, which were much, much higher levels and quite concerning across the board. And there was some question as to whether they were going to be to negotiate or not. Right now, the market is looking at some certainty and some uncertainty. Clearly, the market's driven right now by a lot of AI spending, a lot of CapEx in technology. This is all very, very good things for the U.S. economy. On trade, I think it's going to take time to see how these tariffs have an impact, and different businesses will be impacted accordingly. So some will be winners and some will be losers.
Do you think these negotiations are still open for negotiation? And what I mean by that is even deals that have been reached with the EU, for example, or Japan or the like, that he could go back to the well and say, actually, I need you to do X, Y, Z in the future, and if you don't, we're going higher. Or I need you to do X, Y, Z in the future, and it will go lower.
Well, I think the first thing that the market is looking for is actually an outline of what the specifics of the deals are, since clearly tariffs are only one component of it. Non-trade barriers are another very large component in making this more equal in terms of trading, and then investment into the U.S. So I think we're all actually looking forward to the documentation. But I think, look, President Trump is a negotiator, and he's made it very clear.
Do you think there are teeth in these deals, though? And we asked the president this morning, because I was going to say, under his last term in that office, there were some investments that were announced by China into the U.S., but ultimately they didn't come to pass. And I just wonder how much teeth, whatever these commitments are, how committed they really are.
Well, I think, the China phase one trade deal, it was a very large deal, very important, negotiated over a long period of time and lots of different chapters. Unfortunately, what happened is once we got into COVID, China didn't adhere to the deal, and then the Biden administration didn't enforce the deal. So I think one of the important parts of the China negotiation is to make sure that China lives up to the commitments they made in the phase one deal.
Do you think that he should give out some of this tariff money as dividends to either lower income or middle income people, or would you prefer to go to the debt?
I'd like to see it as deficit reduction. I think, many of us are concerned about the size of the deficit, and there's really only two ways of dealing with that. One is growing the economy, right, and two is creating more revenues. So, no, we should be using the tariff revenue for deficit reduction.
And finally, the president talked about Kevin Warsh and Kevin Hassett as potential Fed chairs, the two Kevins. Which Kevin would you prefer?
I think there's a lot of good candidates. The president mentioned there's 2 other people who he hasn't announced, and I'm sure he'll make a great choice.
You're still a politician. Thank you, Mr. Secretary. Appreciate it.
Thank you.
Thank you. Great to see you. Scott, I'm going to send it back to you.
All right, once and always, Andrew, thank you very much. That's Andrew Ross Sorkin. Our thanks to Mr. Mnuchin as well. Mike Santoli's next. Senior markets commentator Mike Santoli joins us now for his midday words. Good to see you. What are your thoughts today about how this market's reacting?
Not moving fast enough to really break anything or decide anything is the way I would characterize. I mean, it shows you the ISM services miss did have an impact, right? The banks pulled back on that. It seems like it just puts us, in check, but within a range. If I characterize the sentiment going into the month, it's, the market doesn't owe us anything. We've come a long way, due for some seasonal sideways chop or weakness. But don't worry, there's support at 6,100, 6,150, so it won't hurt that much. And then it'll just set us up for the fourth quarter rally. It's very plausible, but is it going to go according to script? Is all the stuff going to fall in line to let us live that out? So I think that's where we are. And the erratic flow from the retail stuff is basically hot or cold depending on the day.
Yeah, that's been unreal, as we talked about top of the show. We'll see you at 3. All right, it's Mike Santoli. Finals are next.
ethos.com.
All right, we'll see you on Closing Bell today. Adam Parker will be with me along with Keith Lerner. Has an interesting new note about where the stock market is heading in his mind. Stephanie Guild, Jim Stewart, ahead of Disney earnings tomorrow, and Sherry Paul of Morgan Stanley Private Wealth. So I hope you'll join me then. Josh Brown, your final trade is what?
Apple may be finding support here. It doesn't seem to want to go down anymore. We'll see.
Well,
but
just as Joe bounced it out of the Joe T. All right.
I did say I might buy it personally.
Okay. Who's PG&E?
That is me. That is a California utility that now there's starting to be clarity about what they might have to pay to resolve the wildfires.
Okay. Industrials have been a great trade. Record high for that group. Second best sector this year. Who's that?
That's me. They're absorbing the tariff impact right now, but they are squarely beneficiaries of infrastructure.
Mercado Libre, nice intraday turnaround.
All right, I'll see you on the bell.
Thank you. Welcome, everybody, to the exchange. I'm Becky Quick. I'm in for Kelly Evans. Stocks giving up earlier gains today following weak economic data and fresh tariff comments coming from the president right here on CNBC. We will get to those comments in just a moment. But in the meantime, a softer than expected ISM services read not really helping investor sentiment today. That index coming in flat in July. That indicates higher inflation and lower employment. Services, in fact, make up about 70% of the U.S. economy. Tariffs were cited as the number one concern for respondents to that survey. And speaking of tariffs, keeping an eye on the chips trade, with President Trump saying tariffs on that sector could be coming within the next week. And that is where we begin today with the big interview of the day. President Trump calling into Squawk Box this morning for a wide-ranging interview, making some news when he was asked about the current contenders to be the next Fed chair, including former Fed Governor Kevin Warsh.
He's very good. Sometimes they're all very good until you put them in there, and then they don't do so good. But a lot of them, I think he's a very good guy. I think I say Kevin and Kevin. Both Kevins are very. I want to stay where I am.
The president referring to Scott Bessent, the Treasury Secretary. Let's bring in CNBC senior economics reporter Steve Leisman. Steve, that was the president saying Scott Bessent has taken himself out of the running, but 4 others remain in the running. As he mentioned, there are the 2 Kevins, Kevin Warsh and Kevin Hassett. We're guessing potentially Christopher Waller, the Fed governor, although he did not confirm that. What do you think about who that 4th candidate might be, whether Waller's still in the running, and how quickly we might hear any of this?
Right. Well, can I say good questioning, Becky, at least for my personal beat and edification. I'm appreciative of what you did there. And it may not be clear, but you did try to follow up and find that 4th person. So it's a little bit, we don't know. I was thinking maybe the CEA chair, Mr. Mirren, is one possibility. There could be others out there. But I think I would focus where the president kept his focus, which is Bessent and Kevin and Kevin, with Bessent being out of the running. I think that was also important news to know that. At least that's where we're at right now. He didn't, I think, explicitly say Waller was one of them, but that's what our understanding is, that he's potentially one of the possibilities there. So that's where we are right now. I don't know if maybe Bowman could be that 4th person. I don't really think so. Call. But remember, he's got this other pick coming up in September.
Right. And he even mentioned that pick that he has coming up as a potential place to put whoever he wants to be the next Fed chair in that position, so that they would almost be the shadow Fed chair hanging out on the committee in the meantime.
Yeah, I'm not sure he would do that. It doesn't make sense. You would do that if you feared that Jay Powell wouldn't leave his seat after, because his actually governor's seat runs on for 2 years. But I don't think there's any question that Jay, once there's a confirmed chair, would step down when his term is up in May as chair, and also leave that governor spot, which he has right alongside the chair spot. So I don't think you'd have a need to do that unless you wanted to try. But you would then say, okay, he's going to be the chair, but the person wouldn't be chair until May. Right. Maybe that would be the creation of that shadow chair thing we've talked about. But I feel like they've kind of walked that back a little bit.
We also asked the president about the firing of the BLS commissioner and accusing her of rigging those numbers following Friday's weak jobs report and revisions.
Well, I think when somebody says the commissioner is not involved, I don't want to get into any arguments with anybody. Why should I? She's a very nice woman.
Exactly.
But when they say that that nobody was involved, that it wasn't political. Give me a break. It's a highly political situation. It's totally rigged. Smart people know it. People with common sense know it. And a lot of people to keep their head under the covers.
Again, that was the president talking about comments that former labor secretary Elaine Chao had made to us. She was the labor secretary for 8 years in the George W. Bush administration, and then she was the transportation secretary in the first Trump administration. She was on with us yesterday, and we talked about it, Steve, just this idea that she said, look, she doesn't agree with the numbers, thinks they could be collected better, but did not think that even though this is always a political appointee at the top of this, the BLS, that person alone would be able to have too much sway or influence over the numbers.
Yeah, where do I send the check, Becky? You guys doing your job for me, my job for me here. Look, here's the thing. I also spoke at length with Erica Grosjean, former BLS commissioner. She told me she gets the census report. Remember, the Census Bureau creates the household report with the unemployment rate. She gets that on Tuesday. She got the payroll report on Wednesday. She's given the numbers. The only question that there is you can go back and you can have a broad discussion about methodology and work with the scientists there, the economists who are working on it. You can have a say on the press release, but the press release, of course, you can't change the numbers in it, but you can characterize it. She told me a story where she tried to introduce a number, and essentially the staff said, no, we don't use those kind of numbers. So she told me a story. When she was asked by somebody if the numbers show the glass is half full or half empty, the right answer from the BLS commissioner is there's an 8-ounce glass and there's 4 ounces of fluid in it.
Correct.
That's how they do things over there.
Correct.
So and one more thing, if I could, which is to just show again. You guys asked about the numbers.
Filled.
The president again repeated that falsehood that the revision came out afterward. The 818,000 came out 3 months before the election. And then I subsequently went and checked out the idea of were there any revisions after the election that showed that the numbers were pumped up before the election? No. In fact, after the election on December 5th, when that jobs report came out for November, they revised up the pre-election numbers, September, October, by 150,000. So again, I'm sorry, Mr. President, but your claims of politics is just not borne out by the data.
When was the November jobs report versus the election day? It was
December 5th was the November jobs report.
No, I'm sorry, the
election,
October.
I believe, was November.
Yeah, I guess November 6th. So we would have gotten the jobs, the October jobs report a few days, like 2 or 3 days before that.
Right. But remember, there's the first and the second revision. So those were the two combined revisions that we knew at the time. They added 150,000 jobs to September and October. So if you were playing politics, you wouldn't have, I don't know, somehow not reported lower numbers. You would have reported higher numbers. But in fact, they reported lower numbers, which was...
Oh, sorry, go ahead.
Now, I was just going to say there have been long accusations. None of them has ever been proven, or no data has convincingly been presented that the numbers are political. Right. There are plenty of data that shows the numbers need to be revised.
Right.
You're right. That's a different story, and that's a discussion we can and should be having. But what I think you don't want to do, Becky, the Trump administration has proposed a 9% decline in the budget for BLS for 2026 and a 9% decline in staffing. So they are discussing the idea of merging some of the statistical agencies. There could be some efficiencies there. We'll wait to see. But I just don't think that if you want better data, you're going to pay less for it. I don't think that's the case.
No, although we have talked about this, I feel like, so much over the last 3 trading days through some of these things. Man, there's got to be a better way to do some of this stuff than the snail mail, than the way they're getting this. And I know it's hard. And you talked this morning about how difficult it is to get real people, to get their cell phone numbers, to get them to respond to some of these things. You would think the government could have a little more heft in compelling, whether it be businesses or households, to give back some of that data. Hopefully, we can get some better numbers. And I think just the respondents, the percentage of people who right back in, it's something like 60% for businesses, and in the household survey, it's something like 43% post-COVID.
I think that's a fascinating idea, the idea of whether or not you want to compel that. I'm not sure the government can compel an answer to a survey. It's an interesting question. Whether or not it can offer a bonus. There are certainly behavioral economics things you can put them in jail, right? I don't think that's going to happen, but you have to, I guess, file your taxes. So maybe you have to file your reports.
Please tell us. Please give us the information, or like we mentioned this morning, maybe pay them. We'll see.
Exactly.
Steve, thank you. Great to see you. Steve Leisman.
Thanks, Becky.
This was a wide-ranging interview with the president. We also asked him about tariffs on two of the world's biggest countries, China and India. We started with the reports of a potential meeting with China.
We can have a meeting. We have a very good relationship, but I didn't call for the meeting. He called for the meeting. So the fake news announced Donald Trump wants a meeting with China. No, I didn't want it. No, he asked for a meeting, and I'll end up having a meeting before the end of the year, most likely, if we make a deal. If we don't make a deal, I'm not going to have a meeting. I mean, you know, what's the purpose of meeting if we're not going to make a deal? But we're getting very close to a deal. We're getting along with China very well. We do very, very little business with India because their tariffs are so high. So India has not been a good trading partner because they do a lot of business with us, but we don't do business with them. So we settled on 25%, but I think I'm going to raise that very substantially over the next 24 hours because they're buying Russian oil. They're fueling the war machine. And if they're going to do that, then I'm not going to be happy.
Megan Casella joins us right now. Megan, so many of these trade deals that have been taking place all at the same time, being negotiated at the same time, and we are facing some new deadlines this week for countries that we anticipate seeing potentially higher tariffs if there's not a deal reached. The president himself said substantially higher tariffs for India expected in the next 24 hours. How do you kind of sort through everything we've heard and figure out where things stand right now?
Yeah, it's an interesting question. Becky, I was just inside actually talking with a White House official following this interview, trying to get a sense of what exactly was coming on India and on a few other of the topics that you guys hit this morning. I'm told there's no update, so the president can't say at this point. He clearly hasn't settled on exactly what rate he's going to land on with India. But August 7th is Thursday. That's the day to really look at because all of the some 70 plus countries that got new tariff rates on all of their exports to the U.S., that's when they take effect is Thursday. The president has sort of had mixed views over the past few days over whether or not he's willing to strike more deals between now and then. Canada, to me, is the biggest outlier, is the biggest trading partner that doesn't have a deal and could potentially see a lower rate. Now, India is the next biggest trading partner that could see a higher rate. I'm curious, he had at one point talked about secondary tariffs targeting Russia, and India would be impacted here, of as high as 100%. So are we set to see 125% tariffs on India? That's something that I'm watching for in the next few days.
And Megan, Thursday is the deadline, but then there are other deadlines beyond that for other countries. I think I'm starting to get to the point where I start to confuse them. China is later this month.
Yes, all good questions. There are so many deadlines to keep track of. Thursday is the biggest one. So that's the next on our calendar. Friday is when tariffs on Brazil, I believe, are set to take effect, as well as the secondary tariffs that he had talked about. Those are both for Friday. China has that August 12th deadline. And this is another thing I was just raising with the White House official. You know, there were the Stockholm talks last week, which both sides said went fairly well. The president, again this morning to you guys, said things are going well with China. But we don't know why he hasn't yet extended that August 12th deadline. And we also don't know exactly what level tariffs would ratchet back up to against China if he decides not to extend it between now and then. The White House couldn't give me any further details as to what was going to happen on August 12th next Tuesday, or as to why we haven't heard anything yet. But that's the biggest question, I would say, after Thursday, is then with China being such a massive trading partner for the U.S., what happens next? We still don't know.
I get why Scott Bessent would want to keep his job at Treasury instead of going to the Federal Reserve. Both huge jobs, but what he's been doing now with negotiating all this stuff is definitely enough to keep somebody busy. Megan, thank you. It's enough to keep you busy, too, and we appreciate it. Our next guest fully expects the president to iron out a trade deal with India, but says it's a little trickier with Europe and China. Joining us right now is Tobin Marcus, the head of policy and politics at Wolfe Research. And Tobin, I get it when it comes to China. That's probably the most complicated deal they're going to have to put together. The second largest economy in the world, also somebody who we're frenemies with, partners on some ways, but really kind of pushing back in a lot of ways, too. Europe, I thought we were already reaching pretty close to what we thought was the outline of a deal. You think that that is not done at this point?
Thanks, Becky. Good to be here. I do think that Europe is stabilized in the near term. I think the question is with the EU in particular, also with Japan, with South Korea to some extent, the president's characterization of the investment commitments that have been made as part of these deals has looked very, very different from how they're being characterized by our trading partners. This morning, when you were speaking to him, President Trump talked about the EU as essentially giving us a $600 billion signing bonus that's his to spend as he chooses. The EU characterization of that has been, this is our essentially sort of survey of what we think private sector investment intentions are, and we have no ability to compel compliance with that target. So
and Japan, by the way, has said, no, this is a loan. This is not money that you can do whatever you want with. This is a loan that you have to repay us.
Right. And South Korea similarly has said it's going to be largely loans and loan guarantees. So, if the president is still in deal-making mode, if he's in kind of de-escalatory mode, wants to keep stuff contained, of course, he can just accept these pledges at face value, proceed with the tariffs he's already put in place, let things go their merry way. But if he's really committed to getting sort of investments of the kind that he's characterizing, then at some point I think that will break down. And the fact that we're not seeing eye to eye could, lead to another round of threats somewhere down the line. So I don't think this is a near-term problem for markets. I think that tariffs are going to go where he says that they're going to go, the rates that were set last Thursday that are taking effect later this week. But, as this term proceeds over months and years, we could see a resurgence of tensions.
So why do you think a deal is imminent with India? It feels like we've been hearing about that for several months at this point.
Yeah, that has been on the tip of everyone's tongue for months and months now. I think that was in the kind of initial tranche that folks were hoping we might get in May or June. I think that we're going to be able to land the plane. I think that Trump and Modi have warm leader-to-leader relationships. They always have. I think that the Russian oil issue is it's an issue, but I don't think it's such a sticking point. I think tellingly, China is the other big buyer of Russian oil. The Chinese keep on huge takers, right? Yeah. And he's not making those threats there. So I think that goes to show that probably the Russian oil issue is kind of downstream of whatever other tensions we're seeing in the U.S.-India relationship, as opposed to that being the driver of the threats that he's making right now. So I think that they'll be able to figure it out. I don't know exactly what that looks like, but as we saw with China, if there is a big escalation, I think we will find ourselves in a position where both sides want to de-escalate before too long.
If I had to place a bet on it, I would say it has to do with agriculture and trying to open up India to U.S. agricultural imports.
Yeah, they had some of the highest tariff levels globally coming into this. They've made some commitments about de-escalating them, but to your point, there are a lot of barriers still outstanding.
Very quickly before you go, Tobin, your thoughts on the next potential Fed chair, what we heard from the president this morning and what that means for the markets?
Yeah, I think taking Besson out of the running makes perfect sense. He is very, very valuable to President Trump where he is. We have our eye on the two Kevins, certainly. For my money, I would expect Hassett as the pick that makes the most sense for him. I think that Warsh is a hawk on the Fed's balance sheet going back 15 years. And again, on your program not too long ago, was reiterating his calls to run down the balance sheet faster. If we see an acceleration of QT, my expectation...
Quantitative tightening?
Quite right. Quantitative tightening. That would put upward pressure on the long end of the yield curve, all else equal. And I think that runs counter to what President Trump is going for here. I think he wants a dub across the board. I don't think he wants to see kind of a bear steepener in the curve with higher 10-year rates, higher 30-year fixed mortgage rates. And so I think that in terms of what he's looking for, a dovishness not just at the short end, but in terms of consumer-facing long-term rates, I think Hassett is a more reliable person to deliver on that.
Okay. Tobin, thank you for joining us today.
Of course.
Tobin Marcus with Wolfe Research. When we come back, our market guest says that there are two key drivers in the market right now. He will tell us what they are and how he thinks traders can take advantage of it. Plus, LNG, railroads, and cybersecurity have seen a wave of deal-making in just the past week. We'll take a look at who could be next and whether that momentum can continue. The Exchange will be back right after this.
This is The Exchange on CNBC.
Order filled. Order filled.
Every spin.
All right, welcome back to the exchange, everybody. Stocks mixed after a whipsaw 2 days. My next guest says that yesterday's rebound after Friday's sell-off proves that FOMO is still driving the markets, but he's beginning to question whether buying the dip is morphing into trying to catch a falling knife. For more on this, we want to bring in Steve Sosnick, who is chief strategist at Interactive Brokers. And Steve, thanks for coming into studio.
My pleasure, Becky.
All right, let's walk through all of this. A lot of things going on, a lot of phrases we're using. First, FOMO. There's still FOMO out there. People are afraid of missing out.
Absolutely. And to some extent, I understand it. You know, it's human nature to not want to miss something. And it's also career damaging if you're an institutional investor and you miss a rally.
Yeah, no kidding.
So you don't want to be
left
that
behind.
You don't want to be that person. You lose your job or you don't get a bonus or whatever. So that is an element of it, and I think that's what drove the market so far up yesterday. I think we started to see people pyramiding on top of the rally because they did not want to miss another dip opportunity.
Okay, so if that was our dip, it was not much of a dip. And I guess that's where you get to. Buying the dip is still alive and well. People buy it before you can even really realize there's a dip.
My analysis there is that the half-life of dips is getting ever shorter.
Yeah.
And I think because people are so afraid of missing the dip, they basically rush in at the slightest sign of one.
Oh my gosh, the market's 1.5% below an all-time high. Buy.
Exactly. But what happens is, you know, it's worked so well. Let me be fair. It's worked extraordinarily well. If something works really well, you're going to keep doing it. And the more you keep doing it, the more it reinforces itself to the point where the dips get ever shorter because no one wants to be the one who even sold before the dip.
Right, because then you look foolish. So I guess what it takes is being proven wrong at some point before people get a little afraid of trying to reach out, buy the dip, and then potentially catch a falling knife.
Well, that's kind of what we're seeing. Yeah. You know, in our most recent report of the most active stocks on our platform, the two stocks that saw the most net buying over the past week were UNH and Novo. And, you know, so that's when you have to sort of question because
UNH and Novo Nordisk have both had a particularly rough time over the last year or so.
Exactly. And specifically over the last week or so with bad earnings. And so they both had big drops. They're both household names. And so people rushed in to buy them.
Order
and
filled.
There you really haven't seen it. It does
filled.
work a lot. It seems to be working a lot better with tech stocks than it does with healthcare.
Okay, so that's what I was going to say. How do I figure out when it's a great opportunity to buy the dip and when I'm at risk of catching a falling knife?
You're always at risk of catching the falling knife because the one time it'll seem perfectly foolproof. Because remember, the market has a way of making the maximum number of people wrong at the most inopportune time.
Right.
And so what does happen there is you want to be judicious. You want to be doing it for a reason. Don't do it reflexively. If you really think that this company has a value, there's something to it, that's great. If you think that you're just doing it because the stock is lower and therefore reflex tells me I should be buying, maybe you want to do a little more analysis and a little more thinking before you just react.
So Figment has only been trading for not even 3 full days at this point. I know the IPO was last week. I watched it. And I still have a hard time believing it when you see every statistic that it's hit along the way. Where has it jumped in terms of your screens?
It's fascinating because on a rolling 5-day basis, Figma is the number 4 most, as of this morning, as of yesterday's trading, was the number 4 most active stock on our
Without even having 5 full days of trading.
Without even having 5 full days of trading. So call less than half of the time of that measured in that data. Figma's been a public company. And it's been steady net buying. Interestingly, the net buying increased each day. So, you know, obviously the first day was net buying. Then the second day was net buying of even more. And as we fell yesterday, there was even more net buying. So people have just been continuing to love the story. And interestingly, Circle, which is sort of the prior version of Figma, fell from like number 8 on the chart to about number 20 on the chart. So people, I think, have been moving their attention from the last hot IPO to the new hot IPO.
Yeah, new flavor of the day.
Exactly.
Steve, thank you very much for coming in. Steve Sosnick. All right, when we come back, Disney snapping a 7-day losing streak yesterday, ending its worst stretch in a year. Now it's set to report results. That comes tomorrow morning, and there are two big things investors will be watching. First up, the parks. Second of all, streaming. We've got the details straight ahead. And don't miss a big interview with Bank of America Chairman and CEO Brian Moynihan. That is coming later today. He's sitting down with Andrew Ross Sorkin at 2 p.m. Eastern Time, and we will give him a chance to respond to some of President Trump's comments from this morning. Here's what the president had to say.
Brian was kissing my ass when I was president, and when I called him after I was president to deposit $1 billion plus and a lot of other things, more importantly to open accounts, and he said, we can't do it. No, we can't do it.
Doctor today.
All right, welcome back to the exchange, everybody. Stocks are mixed today. The Dow's actually back in positive territory, while the S&P and the NASDAQ are both a little lower. You're talking about modest declines, down 13 points for the S&P and down by about 70 points for the NASDAQ. The 10-year yield, meantime, is hovering right around 4.2%. Dom Chu is here. He's got a closer look at the day's biggest movers, and we were just saying how glad we are to be here together.
It is like deja vu. It's like Squawk Box all over again, except the exchange at 1 o'clock in Englewood Cliffs, New Jersey. There you go. All right, so both of us are going back to work early tomorrow morning, but if you take a look at some of the stocks on the move, Palantir shares right now, not the best performing stock in the S&P, but arguably getting the most attention. Those shares are up roughly 7% right now, hit a record high earlier today after the defense technology company reported better than expected quarterly results. Revenues in the quarter topped $1 billion for the first time ever, due in large part to demand for AI products and a 53% jump in revenues from U.S. government contracts. Palantir also raised its full-year outlook. Those shares, by the way, are now worth roughly $380 billion, which means it has now surpassed the market caps of companies like Procter & Gamble and Home Depot as well. So keep an eye on Palantir. Then you got shares of Pfizer, which are up just around maybe 4% or so right now. The pharmaceutical company also reported quarterly results that topped consensus estimates, due in part to better sales of its COVID-related treatments and vaccines, also drugs used to treat cardiovascular disease. Pfizer also raised its full-year profit forecast given the better performance alongside effective cost-cutting measures. Those shares up 4%. But it's not all great news and positive price performance. Shares of Gartner are plunging to the tune of 28%, making it far and away the worst performer in the S&P. After the advisory and consulting services provider reported better than expected profits and revenues, but cut its full-year sales forecast due in part to expectations for slower growth and demand for its Insight division. That's the one that provides research products. It's its biggest business unit overall, Becky. So Gartner down 28%, a very bad day for them. I'll send things back over to you.
Tom, thank you. And by the way, it's really nice to see you in person right here.
Me too.
And I like your sneaks.
Thank you.
All right, see you tomorrow morning. Right now it's time for Bertha Coombs. She's got a CNBC News update for us. Bertha, hi.
Hi, Becky. The General Services Administration today classified OpenAI, Google, and Anthropic as approved AI vendors for the federal government. The GSA said federal agencies can use the company's models in their mission-specific applications. The approval is part of the administration's priority to stay ahead of China in artificial intelligence. The Trump administration also working to cancel $7 billion in federal grants for solar panel installations. The New York Times reporting the EPA is drafting letters to nonprofits and state agencies that received the grant money under a program that was intended to help low and moderate income families install the panels on their homes. EPA has yet to respond for comment. And by 2029, NASA might be able to send a small nuclear reactor to the lunar surface. In a directive to staff last week, NASA's acting administrator, Sean Duffy, warned China that China and Russia are trying to deploy a reactor by the mid-2030s. And if the U.S. doesn't deploy first, it could get shut out. That story first reported by Politico. Yeah, apparently they
Why
are
do we
in
want to send a nuclear reactor to the moon?
Well, the thinking is that if China and Russia get there first with one, they will shut us out.
And why do they want to send a nuclear
secure.
reactor to the moon? What are we doing with this?
I guess
Running
we want a
cables
new
back to run the
Cold
power
War-
back to the U.S.?
Cold War up on the moon, I guess. I don't know. It's one of those very competitive situations. And I guess the feeling is if we're not there first, that will be bad for us.
Because they're going to take the whole planet with their nuclear reactor? Okay.
That seems to be the thinking.
Too many boys talking, I think. Bertha, I know you're here somewhere. I can't see your shoes, but it's good to see you. Thank you. All right, when we come back, M&A no longer MIA. We've got global deal-making activity hitting highs not seen since the pandemic. We're going to take a look at whether that momentum can continue. That story's next, right here on The Exchange.